Hi, I'm Todd Rosenbluth, Head of Research at VettaFi. I'm excited I'm joined by Kirsten Chang, also part of our VettaFi team. Kirsten, how you doing?
I'm great. Thanks so much for having me down in the office, Todd. It's great to be here with you.
Yeah, we're in the New York studio and there's so much going on in the ETF space, but the hot topic for me is fixed income because this year we've been waiting for the Fed to finally cut interest rates. And maybe it'll happen by the time people are watching this, but tell us what's going on in the fixed income ETF space.
Yeah, so just to put it into perspective, $500 billion in ETF inflows already at this point through the year. We're on pace for a record year. We could hit the $1 trillion mark, and nearly a third of what we've seen already has been fixed income ETFs. So huge story there. Ever since the 10-year yield kind of topped out in April, we've seen bonds just off to the races. So, swinging from a bearish market to a bullish market, and people are really starting to extend duration. They're starting to bet on those longer term treasuries. So we saw TLT, for example, that's the iShares 20 plus treasury bond ETF. That has taken in record weekly inflows, record daily inflows recently. And a lot of large asset managers are taking in a lot of duration as well in their model portfolios.
Yeah, we're seeing folks that are willing and interested to take on that risk because they're going to get rewarded as the Fed begins cutting interest rates, likely multiple times, or at least according to consensus, in the second half of the year. What else are you seeing taking on duration risk?
In terms of, basically in 2023, we've seen investors kind of nestled in the warmth and safety of short duration treasuries, and the money markets have paid off in big time. But I think that that's going to start to cut back if we do see those Fed rate cuts, which we likely will, 100% baked in for September, and probably about 2.5 by the year end is what people are expecting. So lots of dovishness out there. And then I do want to mention active fixed income at large is also a huge hot topic this year. I think this is personally a golden age for active fixed income ETFs.
A golden age for active fixed income ETFs. I love that. Tell me why.
Well, first of all, on the active front, we've seen about a third of all net cash going into active strategies this year alone. And a lot of that is fixed income because people are looking for ways to get that fine-tuned, more focused exposure on the fixed income space, pinpointing, specific points on the credit quality spectrum or the duration spectrum. So I think that's a really huge part of it.
So you're right. We've seen the index-based products where we're seeing duration risk. So you mentioned iShares, Vanguard, and State Street have those products, but we're seeing more active managers come in to the ETF space with fixed income strategies. Capital Group, T. Rowe Price, Fidelity's been there for a while. PIMCO's been there for a while, but more and more of these firms, that's bringing the best ideas into the ETF space.
That's right. A lot of the sort of franchise fixed income mutual funds that we've seen are able to convert all of that power and that expertise into an ETF wrapper. And so I think that's becoming a huge part of it. And, also we just recently had our fixed income symposium, as you know, and nearly a third of the advisors that we polled said more than 50% of their fixed income exposure has been active strategies. So people are clearly using those tools.
Yeah, and they're coming, thankfully, to us at VettaFi for education and to learn about those strategies because the future is going to be bright for the ETF space, but you want to be able to go and understand these individual products. So anything quick you want to end on fixed income with?
No, I think it's, a prime time to be in the space. And I think we're going to continue to see more and more of these products across the whole curve. I mean, they've been betting on bonds in a big way because people are looking at the Federal Reserve, they're looking at the landscape for interest rates, and they're willing to take on more interest rate risk, that duration risk. But I think people need more tools to do that, essentially. They've been betting on broad bond market ETFs and also everything from the short end to the long end. So it's nice to have a full range of products out there in the marketplace.
Kirsten, so let's pivot for a moment and talk about real estate because that's one of the equity markets that can benefit as the Fed begins cutting interest rates, right?
Absolutely. Actually, we've seen real estate ETFs really perk up in terms of both flows and performance over the past month. REITs started off being that lone sector in the red for much of the year, and that kind of changed its tune in June. We saw like 4 months of net outflows being snapped, that losing streak being snapped in June. So people are starting to come back to real estate. Home prices are obviously still at record highs. Tight inventory is still an issue, but mortgage rates are trending down, and that should be helpful, especially if the Fed continues to cut rates. We'll see more affordability. We'll see some of that much needed inventory come back onto the market.
And so that's a defensive sector. We've seen utilities also see inflows, one of the leading utility-oriented ETFs. Tell me more about some of the flows, the trends that you're seeing within the real estate ETFs.
Well, the REIT space in general is seeing a lot of traction because even though we have that sort of office space diminishing because of the pandemic, and ever since then, people are working from home a lot more, we're still seeing a rapid expansion of residential, of industrial, of healthcare. With the long-term demographic shifts, we're seeing some of those REITs really get some inflows in there because people are living longer, and so they will need senior housing. And so that's continuing to gain traction. And globally around the world, monetary policy is loosening up, and it's all been a boon for the real estate and the ETFs globally and domestically.
And we have some of the largest asset managers that have an index-based product, Vanguard and iShares and State Street. There's also some actively managed ETFs that are offered that are tied to the real estate sector. So it's an exciting trend to be watching, right?
Absolutely. Can't wait to see what happens next.
So thanks for joining me here in New York. This has been great, and thanks for joining us for What's Trending. We'll see you next time.